Imagine the global financial system, right? It's this huge, intricate machine. We often focus on the stock market, the fast engines or maybe long-term bonds funding big projects. But behind all that, there's this vital, almost invisible lubrication system. It keeps everything running smoothly. It's all about the short-term flow of cash. Have you ever wondered, say, where your safe cash goes when it's not just sitting in a basic savings account? Or how banks manage to lend vast sums to each other literally overnight? Well, today, that's exactly what we're diving into. The fascinating, often overlooked world of the money market. Hmm. Yeah, our mission today is to really unpack this thing. We want to go beyond just the definition and look at its big role in the whole global financial setup, how it affects everything from huge institutional needs down to your own personal savings. We'll look at who's involved, the different kinds of investments, and that really crucial balancing act between safety, liquidity, and, well, return.
It's fascinating, actually, because the money market, it might seem complex, maybe a bit dry with its lower returns, but it's genuinely one of the foundational pillars. It's the engine room for short-term capital, making sure governments, big companies, banks, they all have the cash they need right now. And, it feels like it might just be for the big players, but it really has this dual nature. There's the wholesale side, huge deals happening constantly, but there's also a retail side. It's surprisingly accessible to individuals, to you.
Okay, right. Let's dig into that definition a bit more then. The money market. It's not like a building you can go visit.
No, exactly. Not a physical place like the stock exchange floor.
It's more of a network,
Yeah,
a market dealing in what, huge amounts of short-term debt?
precisely. High volume, short-term debt instruments. Think of it as a place where money gets borrowed and lent for really short periods. Overnight, a few weeks, maybe a few months. And the main selling point isn't massive profits. It does offer some return, sure, but the big things are safety and liquidity, being able to get your cash quickly.
Okay, safety and liquidity. Crucial.
Absolutely.
Yeah.
And connecting that to the bigger picture, well, the money market is like the essential plumbing for the financial economy. It lets anyone with spare cash, big institutions, governments, even you lend it to those who need funds right now, short term.
Like who? Give us an example.
Okay, maybe a bank needs to meet its overnight reserve requirements. Or a corporation needs cash to finance inventory for just a couple of weeks. Or even the government, just smoothing out its tax receipts and spending. It's all about allocating capital efficiently, getting money where it's most needed right now, the short term. It prevents everything from just seizing up.
Right, prevents those liquidity crunches we sometimes hear about.
Exactly.
So for you listening, what's the key takeaway here? What does it boil down to? Well, it seems like liquidity, flexibility, and safety. Those three things. That's what makes it so useful for managing cash you might need soon. An emergency fund, maybe saving for a down payment, or even just the cash sitting in your brokerage account waiting to be invested. Now, you mentioned it's not just for the big guys. While, yeah, a lot of the action is between huge institutions, you can absolutely get involved in the money market. Directly or indirectly, it probably touches your finances already. So let's look at the main ways individuals can participate. Where should we start?
Well, a really common starting point for individuals is the money market account, an MMA.
Okay, MMA. Heard of those.
Yeah, they're basically a type of savings account you get from a bank or a credit union. What makes them different is they usually offer slightly better interest rates than just a standard plain vanilla savings account.
Any examples? Like what kind of rates are we talking?
Sure. Our sources mentioned back in May 2025, you might see online banks offering maybe around 4.40%, often with a minimum deposit, say $1,000 or something like that.
Okay, 4.4%, not bad for safe cash. And you mentioned safety.
Yeah.
How safe are we talking with MMAs?
Very safe. That's the main appeal. If your M&A's at a bank, the funds are insured by the FDIC, the Federal Deposit Insurance Corporation, up to $250,000 per depositor, per institution.
And credit unions?
Same idea, but through the NCUA, the National Credit Union Administration. Same coverage limit. That insurance is really the bedrock. It gives people confidence, prevents bank runs, lessons learned the hard way in the past.
Definitely, but there's always a catch, right? What are the trade-offs?
There usually are. With MMAs, you often need a higher minimum balance than a basic savings account. And importantly, there are federal rules, Regulation D technically, that used to limit certain types of withdrawals and transfers to 6 per month. While some limits were relaxed, banks can still impose their own.
Ah, so maybe not quite as flexible as a checking account for frequent access.
Exactly. And if you go over those limits too often, the bank might even have to convert your account into a regular checking account. The detail, but worth knowing.
Right, good point. Okay, so that's money market accounts, but then you also hear about money market funds, MMFs. Sounds similar, but different.
Very different, actually, and this is where it gets a bit more complex for individuals.
How so?
Well, MMFs are mutual funds. They pool money from lots of investors, and then they use that pool to buy a basket of those wholesale money market instruments we'll talk about later, like commercial paper, T-bills, etc.
So you're not depositing money in a bank, you're buying shares in a fund.
Precisely. And their big goal, their whole design, is stability. They try really hard to keep the value of each share steady at exactly $1. The net asset value, or NAV.
Ah, the $1 baseline. I've heard that phrase.
That's the one. It makes it feel like cash, very stable.
Feels stable, but I also hear the term breaking the buck. That sounds less stable. What's that about? How big a risk is it?
Right, breaking the buck. That means the fund's NAV actually falls below $1 per share. So investors could lose a bit of their initial principal investment.
Has that actually happened?
It's rare, very rare. But yes, it has. The most famous instance was in 2008, during the financial crisis. The Reserve Primary Fund held debt from Lehman Brothers, which went bankrupt. Its NAV dropped to 97 cents per share. Investors eventually got back about 98 cents on the dollar, but it caused quite a panic.
Oof. Okay, so the key difference then.
The absolute key difference you need to remember, money market funds are generally not FDIC insured.
Ah, big difference.
Huge. MMAs are bank deposits, insured. MMFs are investments. They're designed to be safe and stable. They invest in low-risk stuff, but they still carry market risk, however small, not insured against loss.
Got it. So MMA's insured, MMS generally not. Okay, what else is there for individuals looking at the money market space?
Well, there are certificates of deposit, CDs.
CDs, right. But aren't those often for longer terms, like years?
Many are. Yes, you can get CDs for up to 10 years sometimes. But short-term CDs, think 3 months, 6 months, definitely fit into the money market landscape. And they've actually become quite popular again recently. Why? Because they offer pretty good rates, sometimes comparable to MMAs, maybe up to 4.5% based on those May 2025 figures.
And they are FDIC or NCUA insured, right?
Correct. They combine that insurance safety with a fixed interest rate for the whole term. Unlike an MMA, where the rate can go up or down, a CD rate is locked in.
Okay, fixed rate, insured safety. Sounds good. Downside.
The main downside is lack of liquidity. There's usually penalty if you need to withdraw your money before the CD matures. So you're locking your money up for that specific period.
Right. Less flexibility than an MMA or MMF.
Definitely.
Okay, one more for individuals. The really direct route. U.S. Treasury bills or T-bills. Lending directly to Uncle Sam.
Exactly. T-bills are short-term debt issued by the U.S. Treasury. Maturities range from just a few days up to 1 year.
And
considered about as safe as it gets. They're backed by the full faith and credit of the U.S. government. Default risk is seen as virtually zero.
how do you buy them? Is it complicated?
Not really. You can buy them directly from the government through the Treasury Direct website. It's surprisingly straightforward. Or you can go through a bank or a brokerage account.
Yeah.
They work a bit differently, too. They're sold at a discount to their face value. So you pay less than, say, $1,000 up front, and then you get the full $1,000 back when it matures. The difference is your interest.
Interesting. Okay, so that covers the main ways individuals interact. MMAs, MMFs, short-term CDs, T-bills. But now let's shift gears. Let's go behind the curtain, look at the instruments the big players use, the stuff that actually makes up the basket in those money market funds, the wholesale side. Where do we start there?
Yeah, this is the engine room. A good place to start is commercial paper.
Commercial paper. Sounds like paper for businesses.
Huh, sort of. It's essentially a short-term, unsecured loan issued directly by large, very creditworthy corporations. Think big, well-known companies. They issue these IOUs to raise cash quickly, often for things like managing payroll, inventory, short-term operational needs.
Unsecured. So no collateral backing it up.
Correct. That's why only companies with really strong credit ratings can issue it successfully. Their reputation is the collateral, essentially.
And investors buy this. Why?
Well, because it's unsecured, it typically offers a slightly higher interest rate, a better yield, than super safe stuff like T-bills.
Okay.
But still considered low risk because of the issuer's quality. Money market funds are big buyers of commercial paper, also other corporations, foreign banks sometimes. Maturities are usually short, averaging around 30 days, but can go up to about 9 months, technically 270 days.
So it's a way for top companies to borrow short-term directly from the market, bypassing banks sometimes?
Exactly. It can be cheaper for them than a bank loan, and investors get a bit more yield. But again, remember, while low risk, it's still corporate debt. There is default risk. higher than with government debt.
Okay, commercial paper. What about the global aspect? You mentioned dollars held outside the US, euro dollars. Sounds European.
Yeah, the name is a bit misleading. Eurodollars is simply U.S. dollar deposits held in banks outside the United States. Could be London, could be the Cayman Islands, could be Tokyo. Doesn't have to be Europe.
Okay, dollars held abroad. Why is that significant?
The key thing is they aren't subject to U.S. banking regulations like the Federal Reserve's reserve requirements. This can mean banks holding these deposits might operate slightly differently, maybe more efficiently in some ways, allowing them to potentially offer a slightly higher interest rate on these dollar deposits compared to what you'd get domestically in the U.S.
Ah, regulatory differences creating a small yield advantage.
Precisely. And when you're talking about billions of dollars, even a tiny fraction of a percent difference in yield matters a lot.
Who uses these euro dollars?
It's a huge, massive market. Attracts money market funds, big multinational corporations managing their global cash, other foreign banks. It's a vital pool of dollar liquidity outside the direct reach of the Fed. Really helps grease the wheels of international trade and finance.
Speaking of international trade, what about bankers' acceptances? That sounds very formal, very bank-like.
It is quite formal and very important for trade. A banker's acceptance, or BA, is essentially a time draft. Basically, a promise to pay someone a specific amount on a future date that a bank has accepted, meaning guaranteed.
So the bank adds its guarantee. How does that work in practice?
Okay, imagine an importer buys goods from an exporter overseas. The exporter might be worried about getting paid. So the importer arranges for their bank to issue a letter of credit promising payment. When the terms are met, the bank formally accepts the obligation to pay the exporter on, say, 90 days. That accepted draft is the banker's acceptance.
And why is that useful?
Because once the bank guarantees it, it becomes a very safe, highly liquid instrument. The exporter doesn't have to wait 90 days for their cash. They can sell that BA immediately in the money market at a slight discount to an investor.
Ah, so the exporter gets paid quickly, the importer gets the goods, and an investor gets a safe, short-term investment backed by a bank.
Exactly. It turns trade risk into a tradable, low-risk money market security, really vital for smoothing out international commerce.
Okay, fascinating. One more big one, repurchase agreements or repos. These seem to come up a lot when central banks are mentioned.
Yes, repos are absolutely critical. They are the bedrock of the overnight lending market.
How do they work? It sounds like buying something back.
That's basically it. In a repo transaction, one party sells a security, usually a high-quality government security like a treasury bond, to another party. But, crucially, they simultaneously agree to repurchase that same security back at a slightly higher price on a specific future date, often just the very next day.
So it's really a loan, a very short-term loan with the government bond as collateral.
Precisely. It functions exactly like a collateralized loan. The seller is effectively borrowing money overnight, and the buyer is lending money, secured by that high-quality collateral. The small difference in price is the interest on the loan.
And why is this so important, just overnight cash management?
It's huge for that, yes. Banks and financial institutions use the repo market constantly to manage their daily cash needs, meet reserve requirements, fund their operations. But it's also the primary tool central banks, like the Fed, use to implement monetary policy.
How so?
By conducting repo operations, the Fed can inject liquidity into the banking system, essentially lending money overnight, which helps push short-term interest rates down. Or they can do reverse repos, where they effectively borrow money, taking liquidity out of the system, nudging rates up. It's how they control the federal funds rate, their main policy target.
Wow. So this seemingly simple overnight transaction is actually a key lever for the entire economy.
Absolutely. The repo market is the plumbing that allows the central bank to adjust the flow of money day to day. It's fundamentally important.
Okay, that gives us a good picture of the different instruments. Now, it's easy to get the money market confused with the capital market. They both involve finance, borrowing, lending. What's the core distinction we should keep front of mind?
Yeah, that's a common point of confusion, but the distinction is pretty fundamental. It really comes down to time horizon and purpose. The money market, as we've been discussing, is all about short-term debt. Instruments with maturities of less than 1 year. Its main jobs are managing liquidity, keeping cash flowing for immediate needs, and earning a modest, very low-risk return on temporary cash balances. Think operational cash flow, short-term funding gaps.
Okay, short-term debt, less than a year, liquidity focus, and the capital market.
The capital market is for the long haul. It deals in long-term debt bonds with maturities over a year, and equity, meaning stocks. This is where companies and governments raise funds for long-term investments, like building factories, funding research, major infrastructure projects. Stocks, of course, represent ownership and potentially have no end date unless the company dissolves.
So, money market equals short-term plumbing and cash management. Capital market is long-term investment and growth funding.
That's a great way to summarize it. Short-term versus long-term,
Yeah.
different tools for different jobs.
Right. So we've covered a lot of ground individual options, wholesale instruments, the overall context. Let's bring it back to the practicalities. For someone considering using the money market, what are the clear pros and cons?
Okay, the advantages. The biggest pro is definitely the extremely low risk associated with many of these instruments. You've got FDIC NCUA insurance on MMAs and CDs. You've got the backing of the U.S. government for T-bills, even commercial papers usually from top-tier companies. So safety is paramount.
And the other big one you mentioned earlier?
Liquidity,
Yeah.
high liquidity. Most money market instruments can be converted back into cash very quickly, easily, and with minimal loss of value, if any. Perfect for money you might need soon. And as we noted, things like MMAs and short-term CDs typically offer better interest rates than just letting cash sit in a standard savings or checking account. So your safe money works a little harder.
Okay. Low risk, high liquidity, slightly better rates than basic savings. Sounds pretty good. What are the downsides? The trade-offs?
Well, the main trade-off for all that safety and liquidity is low returns. Generally speaking, money market investments typically won't give you the growth potential of stocks or even longer-term bonds. Over the long run, they often struggle to even keep pace with inflation.
Meaning your money might be safe, but it could actually lose purchasing power over time.
Exactly. Inflation erosion is a real risk, especially if you hold large amounts in money market instruments for extended periods when you don't need immediate liquidity. Also, remember fees. With money market funds, there are expense ratios, management fees. They might seem small, but they eat directly into those already low returns. So you need to watch those.
And we touched on restrictions earlier, too.
Right. MMAs might have those withdrawal limits or minimum balance requirements. CDs have early withdrawal penalties, locking up your cash. And critically, as we stressed, money market funds are not typically insured. While breaking the buck is rare, it's not impossible. It's a different risk profile than an insured bank account.
So safety comes with the price of lower returns and potentially less flexibility or access depending on the specific product.
That's the fundamental trade-off, yes.
Okay, this is where it gets really interesting for you listening. How does all this complex machinery actually show up in your everyday financial life, sometimes without you even noticing?
Oh, absolutely. It's often working behind the scenes. For example, have you ever just left cash sitting in your brokerage account?
Yeah.
Maybe between selling one stock and buying another.
Yeah, sure. Happens all the time.
Well, chances are you were invested in the money market without even thinking about it. Most brokerages use what's called a sweep account. They automatically sweep your uninvested cash into a money market fund. It earns a tiny bit of interest, keeps the cash safe and highly liquid, ready for you to use whenever you want to trade again or withdraw it.
Ah, so that cash isn't just doing nothing, it's parked in an MMF.
Usually, yes. It's a very common practice. Or think about your bank. They might proactively offer you a certificate of deposit, a CD. They'll say, hey, you got some extra cash sitting here. Why not put it in a 6-month CD? Get a guaranteed interest rate. That's them offering you a direct money market instrument for your unused cash, giving you a safe, predictable return, though locking it up for that period.
So sweep accounts and promotional CDs, common examples of the money market touching our regular finances?
Very common, practical examples.
All right, so today we've really taken a deep dive into the money market. We've tried to show it's not just some abstract concept, but a crucial engine, a core part of the financial system. It offers vital options, safe, liquid options for short-term cash, both for huge institutions and for individuals like you. We've gone from the basics like money market accounts and T-bills you can easily access to the more complex world behind-the-scenes commercial paper, euro dollars, those critical repos that keep the whole system flowing.
And hopefully this deep dive leaves you with an important question to consider for yourself. Thinking about your own financial situation, your goals, your comfort level with risk, and now understanding these nuances a bit better, especially that crucial difference between insured bank accounts like MMAs and CDs versus uninsured investments like MMFs, how might this shape the way you manage your own short-term cash? What really stands out to you now about balancing those 3 key elements: safety, liquidity, and the potential return you can expect from your cash reserves. It's a personal calculation for everyone.
That's a great final thought. Thank you for joining us on this deep dive today. We really hope you feel a bit more informed, maybe a little more curious even, about this often overlooked but truly vital part of our financial world.